Assalamu alaikum viewers. This is me Sheikh Danish from the platform of the YouTube channel Financial Education by Sheikh Danish, and it's a new channel for me, and I am starting it for you all to understand the international accounting standards and international accounting practical in all over the world. This is same as all over the world. The concepts and recording of entries and each and everything is totally parallel in this Asia, in the Africa, and in the North America. All over the financial accounting is almost same. So we will cover almost all the topic from basic to the advanced level. Basic from the root of the accounting, how what is accounting, how we why we need accounting in business. So we will all this cover in this YouTube channel, and you have to subscribe this channel for onward updates. And we are starting this today's presentation on basic level of the accounting, international accounting. So basically, starting from the first, what is an accounting? Accounting is the process of recording the transaction and bookkeeping of the financial transaction. Actually, in every business, why we need a business, and it's accounting. Accounting is the basic need of any business. Accounting actually records all the transactions of the business in a systematic manner. If we don't do the accounting in the business, definitely at one point of time we will lose our money. Someone can steal our money through paying the checks, uh, paying the checks, and stealing the assets of the company, and nobody will know. Even the owners will never understand what's going on in the company. So by the help of this accounting, an accountant and CFO, as well as the owner and auditor, all will know about what's going on in the business, and where we are heading towards. So, starting from the definition of the accounting, process of recording and bookkeeping of the financial transaction pertaining to the business. This is actually the accounting definition. And why accounting require for any business? This is a systematic record of maintenance, as I told you. Cash to know the cash flow position and profit and loss and business network analysis at any time, anywhere, wherever you are. You can just check out your balance sheet and profit and loss, so you can easily understand what is the net worth of the business. Simply, this is also accounting is needed for the budgeting and decision making. And then we can also detect frauds, and we can prevent frauds from the internal controls applications. So this is basically the purpose of the accounting in any business. There are five pillars of accounting. If you understand these five pillars and basic, what are the roots of this accounting, and all over the world, there are these five pillars is almost applicable all over the world. How accounting is being used all over the world. So standards are being prepared eventually from 90s, 1990, 1973, from the International Accounting Standard Committee has set some standards, International Accounting Standard, and thereafter it has been upgraded, updated up till now, and now it is going to be the International Financial Reporting Standard. We will cover this topic in our future slides, but for this initial information, I am telling you that you have to understand about the five pillars of the accounting. And number one is asset, number two is liability, number three is equity, number four is sales revenue, and number five is expenses. These five pillars is these five things are these five classes is included in every business. And whenever you acquire the business, definitely you need some capital to invest in the business, as well as capital in the form of cash, in the form of the balance, in the form of the different assets. So basically, capital is required for any business initially, and thereafter when you grow your business, you definitely purchase something and you pay something to other party, and that purchases ultimately went into the customer point, and customer when these inventory goes to the customer side, so this is called as sales or sales revenue and sales of the company. And this sales is basically deducted from the expenses incurred to do all the transaction of the sales. So if we deduct from the sales the expenses, so definitely there is a profit or loss margin, or profit margin or loss of the company for that particular period of time. So this expenses and sale difference is called as profit and loss of the period of the company. And if you combine all these accounts, asset, liabilities, equity, and sales and revenue, and sales and expenses, these five heads, if we combine, it is called as the trial balance of the company. Trial balance is actually the balances in individual heads of all these accounts, which we will cover in future slides. But you have to know in initially that there are five pillars of accounting, that is assets, liability, and equity, sales, and expenses. If you understand and memorize it, the codes of initial codes of the 1 2 3 4 5, so definitely in future, you whenever you open an subsidiary account of the subsidiary account of any asset, any sales, any expenses, so starting the code is same as I mentioned here. For asset subsidiary accounts, there is a starting code is 1. For liability subsidiary accounts, there is an initial number which can denote, which can demonstrate easily to the viewer of the financial statement that this liability code is 2, starting from 2, that means it is a liability code. And similarly, if you see the equity side of the accounting, so all their subsidiary ledgers starting with the number 3. And similarly, if we talk about the sales subsidiary ledger accounts code numbers, so it will definitely start with the number 4. And 5 is the last expenses, and all expenses subsidiary ledgers, which we will cover in our next slide, that all those subsidiary ledgers will start from the number 5, right? Now we are talking about what is an asset, what is a liability, what are the equity, and what are the sales, what are the expenses. So assets in the international accounting standards, it is defined as the resource which with economic value that a person, company owns or controls with the expectation that it will provide future benefits and cash flows to the organization. Assets are actually the resources can be in any form, like cash, like your vehicles, like your furniture and fixture, like your plant and machinery, and whatever is installed in the building, and also the next slides. But in short, assets are the resources which are economic, which have some economic value, and which we acquire, and we install that assets in the company in the tangible form. And intangible assets are software and this kind of intangible assets, which we will cover in our next slide. But initially you should know what are the assets, and what are the liabilities, and what are the equity. The liability is the amount or something that a person or a company owes to other, and it is also called obligation to pay. The amount you have to pay to other is a liability. Actually, assets and liability and equity, these three portion is covered under the balance sheet item. And we will definitely tell you what is balance sheet and what is profit and loss. It means that there are two segment of the accounting to report. one is the balance sheet approach, one is the profit and loss, and all these balance sheet and profit and loss item covers in the trial balance. Liability is actually arises when you have to pay to some party on the future date, and balance sheet is created on a single date or any point of time. You say when a period is closing at 30 June 2024, so definitely at that moment of date and time, you have to create your position of the company, how you know what where your assets are, how much of value is there in the company books of the assets, and as well as what are the liability value in the books, as well as what is the equity value of the owners. So this shows the liability shows actually the obligation to pay to someone. Similarly, if we talk about the equity, the third number, it is the value that would be returned to the company's shareholders if all the assets were liquidated and all the company debts were paid off. Equity is actually the total assets minus total liabilities. If you see the accounting equation in the previous slide, I have mentioned that asset is equal to liability plus equity. This is an accounting equation. Every time your assets is is almost and fully equal to the liability plus equity. N- in in any no not any case that liability and equity sum is not equal to the assets. If someone is doing that, definitely balance sheet is not balanced. So balance sheet footing balance definitely should match with assets and equity and liabilities. If we will also cover this in the future slide, how we can prepare the balance sheet and profit and loss. So I have shown you three pillars of the accounting: assets, liability, equity. So now we are talking about the fourth pillar, that is sales revenue. It is starting code is 4. And what is the sales revenue? Sales revenue is the sales money received from the normal business operation. Selling price per unit multiplied by the unit sold. And it also can be categorized. Sales revenue can also be categorized as export sales, local country sales, scrap sales, and service revenue. So basically, the sales is the fourth pillar of this accounting. And as I have earlier told to you, that sales are that amount which we receive from our customer in the form of sale. Whenever we record the sale, we definitely record at some value, and the amount we have sold, the quantity we have sold is definitely multiplied to the unit price of that inventory, and the some multiply sum is multiplication value of unit sold to the unit price is called the sales revenue of the company. And this is how many units you have sold during the month, during the year. If you sum up all those values, this is called the sales revenue of the company. Number fifth player, if we talk about the expenses, what are the expenses of the company? Expenses are the costs that the business incur to run their operations. Expenses in profit and loss categorized into operating expenses and non-operating expenses. Expenses, actually, we have every businessman have to incur some expenses to acquire to earn some revenue. So this is an operational cost. Sometime the businessman incur some expenses for the operations, and some expenses for out of operations for the company. So these five pillars I have told to you in brief, that you should know about. Acha. Then we are talking about we have learned all the five pillars of the accounting. Now we can talk about the what are the basis of accounting for recording. How we can record the transaction in the company books. There are two methods. Actually, the cash basis of accounting were traditionally used in the ancient times for the inflows and outflows type of accounting. But at that time, they were not aware that we have to record those expenses which we are paying in future date. So they have no idea about that or at that moment of time in the accounting language. So they previous businessmen in ancient era use the cash basis of accounting. So there were two bases of accounting which are applicable in the world. That is cash basis of accounting. Cash basis of accounting, actually the revenue and expenses record at the time of the cash is received or paid out. Whenever any amount is paid to the vendor, that is being recorded in the system as an outflow, and whenever the cash is received from the customer, so it is recorded as an inflow. So difference between the inflows and outflows is called the somehow balance profit, or sort of a balance inflow outflow, surplus or deficit, you can say. So those businessmen which are not that much educated from the accounting point of view, so those businessmen use this approach for the cash basis of accounting. They want to know simply what how much amount is received today and how much amount is we have paid today, or in the month or in the year. So this is the one side of the cash basis of accounting. But international accounting standards as emerged, and after world has uh, consolidate all their standards to one forum, that is International Accounting Standards Forum. So then they realize that we have to use the accrual basis of accounting procedure. Accrual basis of accounting procedure. What is an accrual basis of? Actually, accrual basis, from the accrual basis of accounting, if we talk about to record income at the time when the revenue is earned, regardless when the cash is received. Uh, Whenever you have income earned by the company, definitely it has to record as per the accrual basis of recording. As per the accrual basis of accounting, he has to record right now the income in the books. And definitely it would be the entry like receivables debit and sales credit. So revenue or income is recorded at the time of when it is earned, but not cash is received on the basis. And similarly, record the expense when the liabilities are incurred, regardless of when the cash is paid. So it is a vice versa situation for the those profit and loss basis of account, sales and expenses, that you have to record the expenses on the when it is incurred, and on the its liability would be paid regardless whether liability is paid after a month, after a year. So the entry would be like a expense debit and payable credit. So this is actually accrual basis of accounting, which shows the actual position of the business and financial transaction at any point of time. So this has been almost followed in all over the world, accrual basis of accounting. And what are the actually debit credit concept? What are the debit credit concept? In previous times, they were using the single entry basis of concept like inflows and outflows. So now after the inception of the international accounting standard, they have set two line debit credit rule. They have injected, and what double entry concept demonstrates. Actually, the debit and credit concepts are very similar. If someone know this chart, so he can easily perform any financial transaction based on this chart. Like whenever the asset is increased, he has to debit the asset. Whenever the expense is increased, he has to record expense as debit. And similarly, vice versa, if we talk about the balance sheet item of credit side, like liability is the credit side of the balance sheet and equity is the credit side of the balance sheet. So if liability is increased it at any point of time, So liability increase will definitely goes to the credit side, and it will whenever increase it will go to the credit side. Similarly, equity behavior is same as of the liability. Whenever equity increase, it will credit to the accounts. We will talk about what is an equity, what are the further liabilities and subheads of these liability in our future slides. Similarly, the behavior of the sales revenue is almost same as of the liability and equity. Whenever sales is increase in the system and of the period, it will definitely credited. So every basically concept, debit credit concept is whenever you have to record any financial transaction, you have to take some account to the debit side and some account to the credit side, and both debit and credit side of the transaction should match at any time. Whenever you make the entry, if your debit and credit is not matched, the entry will not be recorded in the system, ERP system. So if we do all the correct accounting, correct debit, correct credit, whenever we record every expense in properly debit account and sales to the credit side, definitely the trial balance, footing balance will match from debit to the credit side. This will if the trial balance debit and credit side is not matched, definitely it would not be the correct financial position. It will not be the correct position of the profit and loss based account and as well as the balance sheet accounts. If we go at the first slides, this one, let I will recall you about first you have to create the company. Then you create the chart of accounts of the company. Chart of accounts are those accounts which I have told you, that asset subsidiary accounts, liability subsidiary accounts, equity subsidiary accounts, sales subsidiary accounts, and expense subsidiary accounts. These all accounts are, if we merge in a sequential top to bottom order, so it is called the trial balance, and the balance which are appearing in the subsidiary ledgers, it will sum up to the trial balance, and this trial balance debit and credit balance will be matched at any point of time. So first company prepare the company name, then they make the chart of account. Then after creating the chart of account ledgers and in the system, so they prepare entries in the general ledger for making some expense transaction, for making some sales transaction, for acquiring some asset transaction, for paying some liability transaction, and for increasing the capital of the company. So all those entries sum up come into the balance sheet and profit and loss based account. And as you know that there are two portion of the trial balance, that is balance sheet and profit and loss. So balance sheet is also known as statement of financial position in the international accounting standards. And as I have earlier told that in accounting equation is asset is equal to liability plus equity. Similarly, if we talk about the profit and loss, the international accounting standards now are saying that its name is has been changed from profit and loss to the standard statement of comprehensive income. Basically, this balance sheet name was the earlier name which was called all over the world, but now the standard says that you have to uh, you have to write the statement of financial position at the top of the balance sheet, and at the top of the profit and loss account you have to mention the statement of comprehensive income. One thing you have to keep in mind that the balance sheet is prepared on as on date basis. Balance sheet can never be for the period. Balance sheet itself says that the balance at any point of time and any point of date, at the closing year, at the closing of the quarter, and whatever. So it is showing the position of the company, right? But profit and loss is actually the uh, profit, sales of that period and expenses of that period. So definitely if we deduct sales revenue from the expenses, that would be for the period of the company, that would be for the period. And that's why statement of comprehensive income after this line for the period ended is always mentioned in the books of account when someone is preparing the profit and loss account. Now coming back to the next slide, what are the types of assets and liabilities? Assets are of two types and liabilities are of two types. One is the current assets and non-current assets. Similarly, liabilities types are current liability and non-current liability. The big difference between these two types are actually current assets shows how much assets you have that is being used for some one year only. That can, the like cash you can use for a 1 year, the like trade receivable you can uh, recover from your customer in a 1 year period, inventory you can consume within a year. So all those current assets which are current assets are those which are used and consumed and converted into the cash and cash equivalent basis in a single first year. Is less than its tenure is less than a year is called as current asset, while the non-current assets, which those assets which can be used after a 1 year period, that assets are called as non-current assets. Similarly, we can talk about the current liability. The current liability is the liability which a company has to pay for within a period of 1 year. This liability is shown as current liability in the balance sheet. And the fourth one is non-current liability. Non-current liability is definitely the amount of the liability, the obligation to pay by the company to someone for the period in excess of 1 year. So this is the basic, these are the two types of the assets and liabilities which needs to be definitely mentioned in the balance sheet at every balance sheet of the organization, whether it is in the applicable in the Asia, whether it is of the America, whether it's of the Europe, all over the world is showing the balance sheet as current assets and current liabilities, and current assets and current liabilities, non-current assets and non-current liabilities, to make sure the user of the financial statement that this asset belong to the it is readily convertible into cash in the period of 1 year, and that liability the company has to pay within a 1 year. So they can calculate easily financial ratios based on this values, that the company is sound enough to cover the working capital of the within a period of 1 year or not. If the company is on liquidation basis and not a going concern, so definitely their non-current liability would be a too much and current liability is almost a too much for so to cover from the assets position. So this picture actually clarify what the balance sheet shows, the balances in current assets and current liability, and non-current assets and non-current liability. If we uh, talk about the current assets and what are the current assets and what are the non-current assets, actually current assets are the cash and bank balances, where whenever the company is created, the first journal entry is recorded in the ledger is the bank debit and capital credit. So and at the first time bank is debit, and it is shown in the current asset section, while the capital is shown in the equity portion. So current assets are these: cash, bank balance, inventory, store spares and loose tools, trade receivables, short-term investment, prepaid expenses, prepaid against expenses, tax due from government, security deposit receivable. These all are the current asset which are readily convertible into cash within a period of 1 year. So these are all uh, called as current assets.